Hi there, Etoro. It is Monday, and that means it's time to take a look at what moved the markets last week. I'm going to keep this video quite focused, so I think that there is one major thing that's really affecting the market at the moment. So last week we saw US stocks suffer their worst week since January as inflation is running hot. In this video I'm going to talk a little bit about inflation as well as historic recessions, because right now the market is worried that the Fed is going to hike into a recession. So the US headline inflation number came out last week. It was higher than expected. Most were hoping for some moderation in the level, but in fact it is the highest of the current inflation cycle. I wanted to break it down a little bit more because it is important to understand what is driving that inflation at the moment. The chart on screen that I've gotten from Bloomberg is very interesting. So the white line is the headline inflation number. So that's the one that you usually see in the media. It's made up of all the different elements that you can see, colored elements that you can see within the chart. Starting at the bottom, we can see that service inflation has been picking up, and this is something that most have expected as the world is opening up and demand for services has been increasing. Above that, we have goods, sometimes called merchandise, depending on what industry you're looking at. But these are the things that people have been ordering, and inflation there has been decreasing. Again, this is something that most expected. The yellow or light orange bar there is food, and food inflation is slightly higher, but not by a huge margin. And then right at the top we have energy, which is another very large contributor to the inflation picture overall. Now it could probably be argued that if there wasn't a war in Ukraine exacerbating supply chains around various commodities, that the food number would be even smaller and energy prices might be flatlining, but that's not the case. This is the current situation that we have. I think the most likely contributor to lower inflation would be lower energy prices. Now inflation is a measure of how much prices have increased since the previous time that measurement was taken. Energy prices have increased in some areas, so the natural gas price in the US has been climbing like crazy, although it is coming down in recent weeks, and the oil price has increased slightly. But given that these prices have been much smaller than previous increases through the last year or so, I would expect moderation in the energy portion of this inflation number through the coming months. Just quickly looking at the components of inflation. So the headline inflation number, we can see it's been climbing. The fear is that we are not yet seeing a peak and that it continues to go higher through June and the rest of the year. And this headline inflation number includes energy and food, just so you know. There's also the core inflation number, which removes, if you read down here, the basket of goods, but excludes volatile food and fuel costs. And you can see that it does look as though that this number is rolling over. Now, of course, people need fuel and they need to eat, so we can't look at this in isolation, but it tells us that at least part of the inflation picture is improving, and a pretty large part. We also need to look at the PCE price index inflation figure, and this is the Fed's preferred gauge, and we can see that this is rolled over in a similar kind of way. Just so you know, this index provides a measure of prices paid by people for domestic purchases of goods and services, but once again excluding the prices of food and energy. So it absolutely blows that this number didn't come in lower. The headline number didn't come in lower or even as expected. It came in slightly higher, and that probably means that the Fed is going to continue to be fairly hawkish. But there are also large parts of the picture that are improving. I was recently having a conversation with a copier, and he was saying there are lots of reasons to be negative about what's going on in the market right now. And he said that he was thinking about selling everything, all of his long positions, and going short on the NASDAQ100. Now, this is something that I've toyed with early in my investment career, and I know that there are a number of other people that do this too, and sometimes you will get lucky. The challenge is, though, that you need to time the market more than once. So you're not just timing the market on the way out and selling out of your long positions, you're timing the market again if you're going short in terms of your short position, getting in and getting out, and then you're timing the market again when you want to go long again. And based on my experience over the past 2+ decades of investing, even if you get some of these timings correct, you're probably going to get the rest wrong. This is also going to be very stressful. Now, based on history, and this is anecdotal, I don't have facts and figures that I can point to here, but most retail investors tend to start losing hope towards the bottom of a drop. At the beginning of a decline, a correction, or a bear market, there's still a lot of hope in the market, and people tend to hold on. They've been calling themselves long-term investors while the markets have been rising, and they still believe it at this point. However, after this has been going on for many months and there's a lot more blood in the streets, that hope starts to wear thin, and people like to get out of the market. The problem then comes in getting back into the market. So you can see, for example, around 2007, 2008, there were a number of bear market rallies. Some of them were quite large. So you would have had to get out of your position, watch the market climb a lot, still stay out of the market, or maybe climb back in and then sell again on the way down. And by the time the market finds a bottom, you don't know that. You only know that looking backwards. So when the market does begin to climb and you've seen, 4, 5, 6 bear market rallies, you probably think that this is just another bear market rally. And when it dips, you're probably going to think that you were right and that you've called it. And then it starts to climb and you once again start questioning whether this is a true recovery or if it's all just going to collapse and go to shit once again. And you start watching the dips thinking that, this is not just a dip. This is going to be a return to that bear market, to that recessionary environment once again. And so assuming you sold out somewhere on the way down through this multi-month, multi-year drop, you're patting yourself on the back. You got out and you were right. But now the market is up 82% from its lows, and you're wondering, when is it time to get in again? Looking backwards through charts, it always seems very simple to time the market. But when you're living it in the moment, there's a lot of psychology at play, there's a lot of information swirling around, and you're relying a hell of a lot on luck. I've shared this guy's blog before, so he writes a lot of posts that are data-driven, so he does a lot of research, he collects information on the stock market, looking back many decades, in this case, I think 100 years or so. And whenever the market becomes particularly difficult, it can be quite reassuring to look back on data to see how the market has behaved historically and what actions you might need to take. So for this blog post, he's got a theoretical situation. He's saying he wants to compare dollar cost averaging to buying the dip. So he says, imagine that you were invested for any 20-year period between 1920 and the year 2000. You could either dollar cost average, where you invest $100 every month for 20 years, or you buy the dip. So that you determine some kind of threshold. You say, if the market drops 20%, then I'm going to invest all the money that I've saved up to that point in time into the market. And so he's picked a random period, 1970 to 1990 here, and a threshold of 40%. So the market drops 40%. You then invest all the money you have on hand at that point in time until the market reaches its last all-time high. And so if we look at this little chart, I think this index is the SP500, and so you're saving money until the market hits a 40% dip, invest all your money, continue to put money into the market until it reaches its all-time high again, and then you start saving your money again. Now in this particular case, this approach actually beats dollar cost averaging by a small amount. And in fact, for the period from 1963 to 1983, that 20-year period, buying the dip beats dollar cost averaging by 29% over that 20-year period. So it might seem that buying the dip is the better strategy in this case. But then he goes on to say that besides these two periods, it's very difficult to find a period between 1920 and the year 2000 where buying the dip actually beats dollar cost averaging. And then, as I was saying before, imagine that you're not going to buy until there's a 20% dip in the market. For some reason, there isn't a dip and the market doubles in price. And then you see a 20% dip in the price, so you decide to invest your money. Now, instead of that being beneficial to you, you're actually buying the market at a 60% premium to what it was when you first decided to take this approach. So the reason that this buy the dip approach is so bad is because when it does win, it tends to win a little bit, but when it loses a lot. It also relies on you getting very lucky with the timing. He goes on to slice and dice the numbers for this particular period. So, if your threshold for buying the dip was 10% or 50%, this is how often buying the dip would outperform dollar cost averaging, and it's far less than half of the time for these various approaches. And we can see that buying the dip in general, in terms of the median performance, it does worse than dollar cost averaging and is a hell of a lot more stressful. I encourage you to read this guy's blog because a lot of his findings are based in data and his summations are almost always the same. It is almost impossible to time the market in a way that's going to lead to you consistently beating the market. It is almost always far better to cost average into the market, and it's also a hell of a lot less stressful. So on to the next chart. The chart that I have on screen is the NASDAQ100. It's the 1 week chart, and I've overlaid the periods and the sizes of the recessions that have occurred over that time frame. So we have the 2020 crash, 2008, and the dot-com boom and bust. Now, part of the reason that I wanted to put this on screen is that in terms of being a long-term investor, which is a very difficult thing, admittedly, to do, recessions end up being very small blips over a multi-year or multi-decade investment time frame. So if we throw a few other stock tickers up here on screen, so we have Coca-Cola and AMD, just two very different companies, we can see that each of them, their stock prices tend to dip during recessions, no surprises there. If you're the kind of person that really needs your investments to be safe, then you might choose Coca-Cola as a long-term investment. And over this 20-year period, you've made a return of 79%. It's not fantastic. It's not awful either. And more importantly, it's suited your investment style. You haven't had to wear a lot of volatility. However, if you don't mind being exposed to a bit more volatility and risk, AMD as a company has been on a very crazy adventure over the last 2 decades as a company. I'm not sure I would have bought them anywhere within this 5 to 7 year period. The early noughties were looking very promising for them, and then Intel just started making much better products than AMD could make. However, over the past 5 to 7 years, AMD as a company has really turned it around, and that's reflected to some degree in their stock price. But you can see the enormous volatility that you would have had to experience if you had stayed invested for the past 7 years or so. Within any portfolio of investments, you want to have, maybe 2 or 3 dozen companies in there. They're all going to perform differently over the lifetime that you invest in them. You're going to have a few that fail completely, some that underperform the market, some that perform just as well as the market, some that beat the market, and hopefully you have a few that just really knock it out of the park, like AMD or, hopefully NVIDIA here, which is even more volatile than the others. But if your investment style is such that you are looking for those nice, big, chunky gains over your investment career, you are going to have to endure a large amount of painful volatility now and again. I mean, look at NVIDIA coming off of the highs over here. Absolutely nuts. But you can see that this was also the case around 2018. So once again, just to re-emphasize my point, it's almost impossible to time the market perfectly. It's far better to own a portfolio of companies that are leaders within their particular fields and can also weather any economic turmoil that is thrown their way. But their stock prices are going to decline when that happens. I mean, if Stanley Druckenmiller can't time the market, then what hope do we have? Here's a little story about how he lost $3 billion in one play towards the end of the dot-com boom and bust. He knew the bust was coming, but he FOMO'd in at the last minute anyway, and he got caught out. I mean, even Isaac Newton gets caught out. I don't know if you know this famous story about Isaac Newton being an incredibly measured, long-term investor, but being caught out by FOMO, buying into the South Sea Company. All right, so things are very volatile at the moment, obviously. The market is trading almost entirely on emotion. There's a lot of fear out there. There's fear that there might be a coming recession. No one really knows. And I found this article, which I think is a little bit tongue-in-cheek, right? Because the author doesn't talk specifically about industries or particular companies that you might need to invest in. Effectively, he says, don't invest money that you need. You're going to need a strong stomach, and maybe you need to stop checking your portfolio obsessively. But once again, looking back at the data, even if you'd gotten the timing absolutely incorrect during previous recessions and bought at the top each time, over a multi-decade investment lifetime, your annualized returns would have been pretty damn good. All right, so what moved the market last week was that higher than expected inflation print from the US, which has created a lot of fear that there'll be a more hawkish Fed, and we will hear from the Fed this week, and that's part of why the markets have opened so red this Monday morning in the US. So lots of bits and pieces of economic data coming out, and lots of it will be very interesting, but the most important will be this event on Wednesday at 7 p.m. British Summer Time, and here we will hear from the Fed about their interest rate decision as well as their outlook for the future. I know it's rough out there, but hopefully I've given you a few data points that you can go and mull over. This is not the first recession that has ever happened. If we do end up having a recession, this is not the first time that the stock market has fallen over a protracted period of time. Eventually, it all comes back. We just need to be patient, disciplined, and have stomachs made of steel.